This video will look at Caterpillar through the lens of FastGraphs, the fundamental analyzer software tool. Research stocks deeper and faster with FastGraphs. We're going to start by looking at Caterpillar from 1992 all the way to current. I want you to notice when we run a 20-year graph, which is as far as we can run, we have to skip a year because we can't get all the data. But what this graph really shows is two things. It shows the cyclical nature of this company, but it also shows it as a growth stock also. As you can see, the orange earnings line here shows earnings growth up through calendar year 1998. Then we had a period of falling earnings through 2002 coming out of the recession of 2001. Then we had this strong earnings advance up through calendar year 2006. Then we had a flattening and then a subsequent falling of earnings in 2008 and 2009. In order to focus on that a little better, we're now going to shorten this graph to the 15-year period so that we can see things a little more clearly. What happened here, though, is because we have less earnings growth, our earnings growth rate has dropped to 9.7%. So as you can see, from 1997 to current, Caterpillar has grown earnings at 9.7%. The orange line here, using the Graham-Dodd earnings determined market price modified formula, applies a 15 multiple to this plotting of earnings you see here. So the orange line represents 15 times earnings. The black monthly closing stock price line, which is obviously the black jagged line, shows volatility, but notice the very high correlation between stock price and earnings over this entire length of time. When we look at performance here, I want you to notice a little bit of undervaluation at the beginning. In other words, the price was below the orange line, and a little bit of overvaluation at the end. So this 9.7% earnings growth rate is actually going to translate into an expanded 12.2%. We started undervalued and ended a little overvalued. So $100,000 invested in 12/31/1996 would have grown to $538,000. That's a 12.2% compounded rate of return. That's almost, that's over 3 times what the S&P 500 was able to generate during that same time frame. So it wasn't the market here, it was Caterpillar. But the real point is that notice the cyclical nature of Caterpillar. If we bring this down to the last 3 years and look at what happened during the recession, we see that as in 2009, as earnings finally quit falling and then began to rise in 2010 and expected to increase again this year, you'll notice that Caterpillar's stock price has recovered, very significantly. So for this 3-year period, a $100,000 investment in Caterpillar would have grown to $226,900. That's a 37.6% compounded rate of return. And when you add dividend income of $7,000, that balloons to over 39% total annualized rate of return owning this stock for the last 3 years. So the recession turns out to be a great opportunity. But I want to go back to the 15-year graph here before I move on to forecasting, because I think it's very important to point out that when you look at Caterpillar over this historical period of time, that that the recent surge in earnings is actually expected to bring it to higher earnings than the company has ever achieved before. And of course, stock price is at the highest level it's ever been before. So, buying and holding a stock like this, as I say in the article, can be very trying, but buying this stock at the right time, coming out of recessions, can be very, very rewarding over short and intermediate periods of time. And finally, before we move on to forecast, we want to look at the dividend record of this company since 1997. As you can see, the dividend has increased every year during this time frame, even through the recession. Now, they only had a 2% increase in 2010, but they still had good, strong dividend growth. So even though there was a lot of volatility going on in the stock price over these years, the dividend continued to grow. Over this 15-year period, a $100,000 investment would have generated $71,500 worth of dividends, or just roughly twice what the S&P 500 would have generated, or what the average company would have generated. Let's move on now finally to forecasting. The current consensus of leading analysts, 19 analysts following this company reporting to First Call, expect growth to continue for the next 3 to 5 years at 17.5%. If the stock traded at 15 times earnings, it would be a $306 stock by 12/31/2016, which is something that I think is at least reasonable based on what they're doing currently. This has been a review of Caterpillar through the lens of the FastGraphs research tool.